Have you ever asked yourself or wondered if Social Security would be there for you when you retire? I'd guess we all have. But since government defaults are pretty rare, and since the Treasury also has the ability to print the money to pay our benefits, I'd like to suggest that we all start asking a different question. And that question is, will I get to keep the benefits that I'm entitled to, that I paid for? That's the question we're going to answer today, so don't keep this video a secret. My name is Mark Tomei. I'm the founder of Hindsight Financial. And all around us today, we're watching mainstream financial planning fail to deliver the results that we, the people, were hoping for. We take a different approach with money, and our clients are saving hundreds of thousands of dollars across their retirement years because they're learning the truth about how wealth and taxation actually works in retirement. So if this topic is interesting to you, join our tribe, become part of our conversation. Subscribe to my YouTube channel, and don't forget to click the notifications bell to be notified when we roll out new content. So if you hate losing money and benefits that you're entitled to, you're in the right place. Let's get started. Is Social Security considered income? This is the question that we pose in this video, and because the government, the Internal Revenue Service, is involved in this decision, we're going to focus on how we can keep our benefits as opposed to worrying about whether they're going to show up or not. So what we're really asking when we say is Social Security considered income is we're asking if the Internal Revenue Service will actually tax our benefit as they would ordinary income. And that's a pretty key differentiator because there's a couple different types of taxes that we could face. And right now, ordinary income is the highest. So our question is, will we get to keep the benefit that we've already paid for and that we are entitled to? And unfortunately, because the IRS is involved in this, the answer depends. So hence the purpose of this video, because the devil's in the details. Let's talk further. I want to first understand the pattern of confiscation. I love the word confiscation. It means somebody's taking money away from you that you don't have to lose. So there are a couple different conversations when you hear questions about Social Security and the benefits. So let's first kind of separate what the Social Security Administration does to adjust our benefit, and then we'll focus on how the IRS treats our benefit. So I'm going to start theoretically with age 70 and our maximum benefit, and then talk through some of the things that we do to chip away at that maximum benefit. So at age 70, you can delay all the way up until age 70, and then you get no further delay credits. So your maximum benefit happens at age 70. Any claim prior to age 70 reduces your full benefit, and that can be a very critical planning consideration, especially for surviving spouses. Whatever income you get, that's what's going to dictate what the surviving spouse also lives on. Our full retirement age is another criteria that we should understand, and it's depending on your birth date, usually between ages 66 and 67. And when you take a claim prior to your full retirement age, then there's an earnings test applied. So if you earn outside dollars, that will reduce your benefit, and that's an adjustment the Social Security Administration makes. And the good news there is you do get that money back later. We'll talk about that more in a different video. The earliest claim age, this is an important one because this is the one everybody talks about, age 62. Now I'm entitled to my retirement from Social Security, but should I take it? That's a very common planning consideration. And what I would tell you at least to consider is you get an 8% credit in your income for each year that you delay your benefit. It's one of the most cost-efficient annuities you can get. And this is something that you will really want to understand. So earliest claim age is 62, but there are some considerations to take because it might be better to wait. Whether or not it's income, the Social Security is your only source of income on your tax return, then you get that money tax-free, just like promised. The problem, and the devil's in the details, when you start adding other income. So we're going to introduce a calculation called provisional income. Provisional income is a calculation that's done for every beneficiary of a Social Security retirement benefit, and it's this calculation that will determine the taxability, or how much you get to keep, of your benefit. So let's look at this formula and see what goes into this. First thing we have to understand is there is a chart, and I will show you the chart, and where your provisional income falls will determine what percentage of your Social Security will actually be subject to income tax. Now, this chart is not being adjusted for inflation since it rolled out. So as incomes generally rise, more and more people are getting pulled into this tax trap. So we've got to be aware of that. Social Security was tax-free until 1984. And they decided that they were going to introduce legislation to allow up to half of your benefit to be taxed if you had outside or other income. That wasn't enough. And again, in 1993, they introduced another round of taxation. This time, up to 85% of your benefit could be taxable. So this is where we sit right now. And then maybe one question to consider is, could there be further legislation that says 100% of your Social Security would be taxable? I would say that that would be probably a fair bet. So provisional income. The first thing we look at is your adjusted gross income from your tax return. To that number, we add half of your Social Security benefit. To the next number we add is tax-free interest, like municipal bond interest. Now hold on, I thought we were all taught that municipal bonds were a great thing for retirees because you get that interest tax-free. You do get the interest federally taxed, income tax-free. However, that number factors into this equation to determine taxation of other benefits. You like that? I didn't like that. That's a stealth tax, and we're going to see more and more of these types of taxes. So this is great conversation to engage in to make sure that you fully understand all the different components. So this provisional income calculation is done, and then we check it against a chart. So if you're married filing jointly, under $32,000 of outside or provisional income, you pay no taxes. Once you hit $32,000, that's when the fund starts. So between $32,000 and $44,000, up to 50% of your Social Security can be taxed. When you get over $44,000 for a married couple, up to 85% of your Social Security will now be taxed. So we're gonna talk through this maybe in a way that makes a little bit more sense. And I'm going to refer to this as the 20% penalty that nobody tells you about. I'm going to give a little case study and a little example. Now, this is basic math, and I do not count this as tax advice. Always consult your tax advisor before making any decisions. But just a basic rule of thumb and a case study to illustrate this point. Let's say Joe and Sharon, 68 years old, retired to their IRA and their Social Security. Their total family household award is $48,000. They filed jointly, and in 2021, they withdraw $40,000 from their IRA to supplement their living expenses. Here's an example of what that could look like. The provisional income calculation, again, half of Social Security, or in this case, $24,000, add $40,000 from the IRA withdrawal, no tax-free interest, provisional income is $64,000. So that exceeds our threshold. 85% of our Social Security can be subject to tax. So what does this look like? If I have a total award of $48,000, 85% of that is $40,000. That can be subject to tax. It adds on to the other income on my tax return. So if I'm in a 25% tax bracket, and I know currently there doesn't exist a 25% tax bracket, that's why it makes this one fun. 25% tax bracket is easy math for us to understand. 25% on $40,000 is $10,000. Remember, our total award was $48,000, but we have to give $10,000 of it back in the form of taxes because we had other income, because of where our money came from. So if I extrapolate that over a 30-year retirement, you're looking at $300,000 of net dollars that you have to give back on your Social Security just because of where you got your other income from. Kind of scary. Did you know it worked like that? Leave a comment in the section below. Let us know if this is the first time you've heard this or if you had heard it before or a different version before. I'm always curious in the conversation out there. But if this video was interesting to you, you enjoy this type of content about the different confusing money traps out there and how they confiscate your money, I invite you to check out my free webinar, The Six-Figure Retiree, the primer with money hacks for the new economy at sixfigureretiree.com. Check it out, and I appreciate you taking the time with this message today. Don't forget to subscribe to our channel and click the bell for notifications as we roll out new videos. Thank you.